Hello, and welcome to another edition of Accounting. Today, we're going to start with Chapter 3. Now, in Chapter 3, part of it discusses the forms of business, the business forms. There are three main types of business forms. There you can organize as a sole proprietorship or sole prop, a partnership, or a corporation. Now, these are the three main forms. There are some hybrids that you'll see in orange. Now, go get to those orange ones that are a bit hybrid type of business forms. But we'll start from the main three, and we'll talk about those in just a moment. Now, a sole proprietorship. Pros are it's one owner. That's why it's called a sole. Now, husband and wife can be a sole proprietorship because when it comes to a married couple, the marital assets, the assets that are jointly owned by husband and wife, are also used in the company. So it's a commingling. And because the wife is, or the spouse is also benefiting from the sole proprietorship, they're also part of the business. So a sole proprietor is one owner generally. It is very easy to set up. And I will demonstrate for you how easy it is. Now watch carefully. It's going to take a lot of work to get this wordy, so give me a second to concentrate. Concentrate. I'm a sole proprietor. Now I'm not. I'm a sole proprietor. Now I'm not. It's just that easy. It's just that simple. There's no legal forms necessary. There's no lawyer that you need to hire. Nothing. You just fill out an additional form with your personal taxes. I believe it's Schedule E for income for us from a sole proprietor. Now, those are pretty much the general easiest, the pros of it. The cons are that as far as the corporation or the business is concerned, any income and taxes that the company is responsible for are really part of the owner's personal tax. So any income from the sole proprietor is actually personal income to the owner, the only owner. And the taxes are the personal tax rate of the owner at that higher level. So if the owner earned $35,000, but the business earned $100,000, now he's at $130,000 tax bracket, must pay $130,000 worth of taxes, not 30. So that's an example of where it's the owner's personal tax. Now, also another con or negative thing about a sole proprietorship is that there is an unlimited liability, meaning that anything that the sole proprietor does as a business is also the liability of the owner itself. If the sole proprietor sold some bad beets and someone got sick off of the bad beets, the sole proprietor gets sued, but that is also the owner. And so the owner's personal assets are at risk in that liability of that suit. So that is a sole proprietor. Most of the companies that you know that are small businesses in the United States are ranked or considered small business. Small business is defined by a majority of the definition is that it has 500 employees or less. And if there's only one or two employees, meaning the owner and his wife, that it constitutes a small business. And about 80% of all businesses in the United States are small businesses, 500 employees or less. And they tend to be a sole proprietor. The next category is a partnership. And don't look at the orange yet. Partnership. And a partnership is two or more individuals that are working together in the business. There are some legal forms that are necessary to be filed with the government. That needs a lawyer to draw up and file. So there's some costs involved, a little more than a sole proprietor, which is very, very easy to set up. A partnership has some legal forms that need to be filed, and so you'll need a lawyer for that. The partnership is only in existence as long as all partners are involved. If any one partner wants to leave the partnership for any reason, I don't like doing business anymore, I don't like you guys, that's any reason, the whole partnership is dissolved. So that means dissolution by one partner. The partnership is dissolved when one partner leaves. The other remaining partners, or if they take on a new partner to replace it, makes an entire new company. the partnership is completely gone. They have to refile new paperwork with the new partners, and that becomes a completely new company. Now, the income and taxes are distributed to the owners according to the amount or the percentage of investment. So if they are, and it's based on the partners' percentages. So if you have two partners that are 50-50 partners, and the partnership earns $100,000 net income, then each partner gets $50,000 and is charged the taxes as if they earned $50,000 plus whatever else income they have. So it's only based on that percentage. If they're three and they're equal, it's 33 and a third. One gets 33, one couple gets 34, one gets 34, whatever. It's based on the percentages. And it's also limited, but I put limited in quotations because it's only limited to the amount of the partner's percentage. Therefore, in a 50-50, if there was a suit against the partnership because the partnership sold some bad beats, then the partners are responsible and liable only up to the 50% of their original investment. Corporation is the one that's most commonly known. It's not the most popular, but the larger companies, if you look at all the companies in the country, 80% as far as number are sole proprietors, mostly. But the corporations is what we think about because AT&T, Ford and GM, and Google and Yahoo and Facebook, those are all corporations, and so they are the larger size. There are many, many owners, and they're called shareholders or stockholders. They are a shareholder and they own stock, and that is their portion or proportion of ownership of the corporation. So in a corporation, there's many owners. There is a high cost to incorporate. That takes a lot of forms. There's articles of incorporation that needs to be drawn up and filed, and that calls for a lawyer to file all that and costs. So there's a higher cost. The owners can come and go as they please, meaning that they could leave the organization, they can come back to the organization because they merely have to buy and sell their stock. The corporation stays intact, so there's no impact on the corporation if an owner leaves. Conversely, in a partnership, if one partner leaves, the entire partnership is dissolved and must reconstitute itself with new partners. With a corporation, an owner can leave and the corporation stays intact. The income and taxes are charged as income. Net income is charged directly for the corporation, and there's a corporate tax rate. It used to be 41 or 42%, but now it is 21%. It went down in the new tax laws, the current tax laws, and that was one big push for why it was passed, is because corporations now pay a smaller or lower tax rate. So all corporations paid the 40% before, now pay 21%. And the liability of anything that the corporation does is totally limited to only the corporation. The owners or stockholders or shareholders are not liable for anything that the corporation does. Now, corporations are actually considered non-human legal entities. A corporation can buy other corporations, like we can buy stuff. A corporation can contract like we can contract. They can own property. They can have children, just like we have children. We call them subsidiaries when we come to a corporation's children, but they're called subsidiaries that, like children. Two subsidiaries together are called sister companies. So they say the same words that we say for people, we can apply it to corporations. A corporation can be a party in a suit, whether they are the plaintiff, or the defendant in a suit. Also, a corporation can be charged with a crime, but usually you can't put a corporation in jail, so there's other ways of restitution for a crime that a corporation may have or allegedly cause. Now, there are some hybrids to these main categories, and it's common enough you probably know heard of an LLC, or limited liability corporation. It's sort of a blend between a partnership and a corporation. The differences between a corporation and an LLC, it's similar to a sole proprietor where it's easy to set up. There is one or two forms that you need to file, and in Michigan it's about $50 or $75 to file the paperwork. You need paperwork for an LLC. You need to file for an assumed name, maybe even a tax ID number, an FEIN, Federal Employer Identification Number, with the IRS to get one, because it is independent of the owners. And the owners of an LLC are called members. And the net income of an LLC is charged to the members equal to their proportion of shares that they have bought in the company. LLP is another kind of hybrid, mostly for professional types of partnerships. LLP stands for limited liability partnership. And it would be in partnerships like law firms or doctor's offices, where you have a professional who has a certain level of expertise or knowledge that you're paying for, and you want them to act as your agent in whatever arena they're working in. A lawyer works in court, doctor works in the health field, and you want to make sure that they are doing what is necessary for you, and they are now, an LLP has certain limitations on the liability, but there's a gradation from unlimited to totally limited. There's a little bit more than totally. It's more unlimited, but not as limited as a corporation. So there's a gradation. There are two main types of corporations. There's S corps and C corps. Again, a C corporation is what we commonly refer to when we think about a business. We think about big businesses like Apple. And a C corporation is a company that has 75 or more shareholders. An S corporation cannot have more than 75 shareholders. Usually it's less. An S corporation, also the net income is charged directly to the shareholders as income, very similar to a sole proprietor, and that's where the taxes are charged. S corporations are not responsible for the corporate tax. C corporations, on the other hand, are. And that's basically the three main forms of organization, business organization, and we'll go to some ethics in a moment. So, when it comes to accounting, there are certain other rules that we have to follow or abide by. And these rules have nothing to do with transactions that we talked about in the previous video. These rules are what is the overarching or encompassing rules that all accountants must follow in every type of transaction and in every statement in what they do. So, what we say is the brown here, this is what we have as a basis of the type of information that we provide as accountants must be reliable. Meaning that whatever it is must be true to the information at that point. And it's true and accurate, and so it can be relied upon, or we can lean on that information when making decisions. It must be understandable, in that this is the reason why we are learning the syntax, we're learning what types of accounts and all that, to be consistent. The consistency is where we breeds the understandability. So we consistently use the same type of information, we're using the same types of transactions, we use debits and credits, and we apply those debits and credits to the same type of way, and so that we consistently keep the information the same, therefore it makes it understandable and obvious to other accountants. Anyone who has had an accounting class will understand what that means. And comparability, that the information is consistent not only in understandability, but in being able to be consistent from time period to time period. So that when we're talking about an asset a year ago, that same asset exists today, and it has a value that is on the books, and that is when we can compare the value and the changes in the value, the book value, over time, and know that it changes because of accumulated appreciation. Now, we have some basic assumptions to keep it reliable, understandable, and compatible, and comparable, not compatible, comparable to time periods, we must make an assumption that this company that we're doing the financials for is going to be a going concern. That's going concern. That is a term, a legal and accounting term, auditing term, that the business will continue and will be beyond this point. And it has a future, and that future is based on the financials that we know that there's going to be another time. There will be yet a time, there will be a tomorrow. And this company will have a tomorrow. There is actually an adverse, similar phrasing, a phrase that's an adverse, there is a concern, that it is not going to be a going concern, and that usually means that the company does not have a future. But the assumption here is in pink that that company is going to continue and will be a going concern. The other assumption is that the numbers that we see or use in financials and in accounting are of the same monetary unit, meaning that if we're talking dollars, we're talking US dollars, we're not talking Australian dollars, we're not talking about the Spanish dollar, which is over 200 years ago, they had Spanish dollars. We're not talking about those, we're not talking about the GBP, the Great British Pound, we're not talking about the Indian rupee. We're talking about the same unit. If we're talking about Indian rupees, then all the financials will be in rupees. If we're talking about someplace in London, then we're going to be talking about everything in GBP, or Great British Pound, or Pound Sterling. And all the accounting information will be in the same monetary unit. It will not switch back and forth between US dollars and euros or whatever. That if we're going to be a US company, yet we're doing business in Germany, then the transactions in Germany will be in euros, must be translated into US dollars to be put on the US financial statements. And we are also talking about a unit of time that is consistently the same length, that every quarter, fiscal quarter, is 3 months. Not one quarter is 1 month, second quarter is 2 months, third quarter is 3 months, fourth quarter is 4 months. That is not a consistent time. So we're talking about that time periods are also consistent. We're talking month to month, not half month to full month. We can't compare. So we are using a consistent time period. And finally, this is the last thing we're going to talk about in chapter 3, really. But we're going to talk about the principles that we must all follow. That we have a measurement, that the measurement is that we record cost we record items at the time of the cost was incurred, meaning that we are not going to put an asset for a car that was worth $100,000 if we only paid $20,000 for it. The books say we paid 20. That's the book value. When we bought it, we paid at the cost that we incurred, that we paid. We paid $20,000. It's worth $100, but we paid only 20. That's what we put on the books. So this is also called the cost principle. The revenue/expense recognition. I lump these into both the same category. The book actually separates them out because it's a timing issue. Revenue is only recognized at the point that either the goods are sold, or product is sold, or service is rendered. And you remember in the last video we were going through all those transactions, and Ace Bookkeeper was prepaid for service that was going to be provided next month. And you remember that we did not put that in revenue as an account. We used unearned revenue because we cannot recognize that revenue until we actually do the service. And that service for Ace Bookkeeper was going to happen next month. Next month, then we can say that we can record and recognize that revenue was earned. Expenses are recognized at the time they are paid for. Whether they're paid on credit through the accounts payable or they're paid in cash, they're recognized when they are incurred. We had a telephone bill in the last video that we will pay next month. and we put it under telephone bill expense, so we debited the expense and credited accounts payable. When we pay, that is the recognition of the expense when we receive the bill. That's when it is incurred. Not when we're calling along, it's when we get the bill. That's when we know that document is what tells us how much we owe. So revenue and expense recognitions at the point that it is incurred. Whether we actually do the service, that's when it is incurred, or when we do the expense and when we get the bill for the expense, that's when it's incurred. So that's revenue and expense recognition. So we can't violate that principle. We don't violate the cost principle. And the last one is disclosure, ensuring that proper disclosure is made when adverse or positive events happen with the organization. Now, this chapter was a bit of a distraction. We're going to come back to understanding transactions more carefully now that you know what to look for. What are my 5 steps? You remember the 5 steps. Remember, cash is king. Remember, never, never, ever, never, ever debit revenue. We also will be talking next in the next video. We'll start with chapters 4, 5, and 6, where we're actually going to do some, we did some transactions. We're going to learn about the general ledger, general journal, general ledger, and financial statements, and the flow, the daily flow and monthly flow of how transactions flow from when they happen to recording the transactions to financial statements at the end of periods. So now we're starting with chapter 4. And in chapter 4 is the beginning of 3-chapter series, a group or unit about the accounting cycle. The accounting cycle is, just as it says, it's the start and end of a cycle of transactions or functions that an accountant or bookkeeper does every period. We start with the journal entries. The word journal comes from the Latin for a root for jour, which means day. In French, we say bonjour. Bonjour, the bon means good, jour means day, so literally it translates as good day. The word journal is day book, and these journal entries are the daily entry of all transactions, the transactions we went through on T's. Remember, the T is a sketch of transactions. The journal is the original or the primary first book of those transactions. So before it goes in the journal entry, we do T's to sketch out transactions. That's what you understand about a T account, so you can do the homework. And like I said, accountants from first-year accountant to a senior accountant, I've worked with many accountants, and they all use T's to understand the flow of the transaction. We sketch it out on paper or sticky notes, and then we can take it back and actually do the transactions in the computers, which does our journal entries. So journal entry, or I will call it JE, journal entry JE. You'll hear me say JE all the time. So we go from the journal entry and we post these to the general ledger. Now the general ledger is actually, a ledger is a book, another book. Now we use computers, so we don't have actual physical books, but the ledger is a book of the entries, and each ledger is a separate account. There is a cash ledger, there's an accounts receivable ledger, there is accounts payable ledger. And so every account we talked about in the first video has its own ledger. Now there's only one journal for the journal entry, or general journal entry, or general journal is what we sometimes call it. I will continue to call it JE. When we do a journal entry, that's in one book, and then the entry or the transaction split to each and posted to each of the general ledgers. and that carries a common balance. That's a running balance. Now, we take all the ledgers and the balances of all the ledgers, much like a T balance or a T foot, we use the general ledger balance, and from the general ledger we create what's called a trial balance. Now this trial balance makes sure that all debits and all credits in that time period equal, because we're going to either do, remember the 5 steps, one of the steps is what account is debited, which account is credited. Sometimes we have 2 debits, sometimes we have 2 credits, sometimes we have one of each, a debit and a credit. But where every transaction is going to have at least 2 of these debits and credits, whether it's 2 debits, 2 credits, or one of each. And so the trial balance helps us make sure that all the transactions of credits that included credits equals all the transactions that included debits. And that is generally the end of our day-to-day function. And we start over the next day with the next day's worth of journal entries. Then at the end of the day, we post to the general ledger. And at the end of the period, we do our trial balance. Sometimes we do a trial balance on regular intervals throughout the period, throughout the month, to ensure that we continue to have a balance between the two. If there isn't, if it's out of balance, it's quicker in the middle of the month to go and analyze and ensure that a transaction is corrected before the end of the month and before the end of this cycle. Now, at the end of the month, we do transactions called adjusting entries. These are journal entries, so I'll put here JE. But they adjust at the end of the month because of accounts that exhaust, partially exhaust, or fully exhaust because of a month. Think about rent. If we prepay rent for 6 months, so if we prepaid on May 1st, we have May, June, July, August, September, October. There's 6 months of rent. And at the end of May, so we've prepaid 6 months of rent. Let's pretend it's $1,000 a month. So we have given our landlord $6,000. That's good for until October. And May has finished. Now we do not owe, the landlord no longer owes us for May's rent or use of that because it's end of May. May 31st, end of the month. And so because it's the end of the month, May has been exhausted. We are only due to use that for 5 months, not 6 months anymore, because 1 month has elapsed. So we have to do an adjusting entry in my example to show that we have used up 1 month of 6 months of rent prepaid. And that's the adjusting entry. We'll do that for prepaid accounts, accrual accounts, and accruals. So that's an adjusting entry. When we've done the adjusting entries, we'll do the same thing we did here with and these are also posted to the general ledger. So actually we go back from here, we basically go here again, and after we do our adjusting entries, which are JEs, just like journal entries get posted, this gets posted to the same general ledgers. We don't stop using the general ledgers, they don't disappear. And then the general ledger here, we make another trial balance. But we don't go here, we're going to our what's called an adjusted trial balance. That adjusted trial balance includes these adjusting transactions, these adjusting entries, these journal entries we do for adjusting. After we do these adjusting entries at the end of the month, we do what's called closing entries. The closing entries are where we close out our temporary accounts to the permanent accounts. And I'll explain that in just a moment. Once we do our closing entry, then we sometimes do another adjusted trial balance, but then we can now complete our financial statements with all this has been completed. And the financial statements are our end result for that time period. Now the financial statements are balance sheet, which is the A equals L plus OE, the income statement, which is summarized as R minus E equals NI, and what's called a statement of owner's equity or stockholders' equity. So, and this is no particular order, 1, 2, and these 3 are our main 3 financial statements. There is a 4th one called cash flow. We will deal with the cash flow statement near the end of class. We will not deal with it today. We're going to be dealing with pretty much the first 2 and the first 3, these 3. So let's focus in a little bit more on what is a journal entry, what is the general ledger, and what does a trial balance look like. On your cheat sheet, you should have a sample of both a general journal and a general ledger. I've summarized it pretty much here. I may have it be a little bit off, but they're generally the same, similar, very similar. With a journal entry for the journal, we have a date column, we have the account name, we have a PR, which means posting reference. We're not going to worry about that in this class, so I'm going to get rid of it right now, but know that that means posting reference. It is a some descriptor, numeric descriptor of the transaction that follows from the JE to the GL. And so it's not necessary in this class. Some companies use it, some don't. You don't worry about it because that would be something that an individual organization will be using as a reference. So I've eliminated it from both the journal and from the ledger. So we have an account field, then we have a debit column and a credit column. Remember, just like a T, in a T account, debit on the left, credit on the right. So if it's a debit, we would put it in the left side. If it's a credit, we'll be putting it on the right side. In a general ledger, the general ledger actually is only for the account itself. There will be a cash GL. So the description would be why did we have that transaction? We'd be putting it in here as some sort of notation what that transaction was for, and that the debit will be posted here. And then there's an additional column here. So we have a debit column, a credit column, and a running balance, which always starts with 0, but that's a running balance. Now, if you have a transaction many transactions that happen on the same date, it's not absolutely necessary to constantly write the same date over and over again. So if it happened on different days, then you must put in a date for the journal entry. The account. Here is how you must write a journal entry. As you see, I'm using a whiteboard, so I do not have this border here. But the first account in any transaction is always going to be the debit account, and the debit is left, meaning on the next to the line. So you would write that debit account first, and the amount. So I'll put a little $sign so it shows up right there. Underneath that would be any credit account. Now, when you do a credit, it must be indented. So a credit is always going to be indented and that amount in here. And the third thing on any journal entry is the description. And when I do a description, I always indent again. So this would be your description of the transaction. For instance, we can go back to the list of transactions we did in the first video and go back to page 45, where the first transaction was the owner deposited $30,000 cash in the business account for Ace Bookkeeper. So we need a date. So let's pretend we have a date. Let's make it 5/1. Just for demonstration purposes. So let's go through the 5 steps using journal entry instead of the T account. We read the transaction. What accounts were affected? Cash and owner's equity, capital specifically. Which accounts are increasing, which accounts are decreasing? They're both increasing. Which is a debit and which is a credit? And that is the crucial question in doing a journal entry, because you must put any debit account first and a credit account second. So in that transaction, cash went up. When we increase cash, which is an asset, we must debit it. So the debit here is cash. And it's capitalized because together. Cash is king, right. And that amount was $30,000. We'll put it in the debit column, $30,000. The capital account was credited. And that credit was $30,000 because the owner put in the money. And we'll write this description here. Owner deposited money in account. Let's do the 7th example, which is on page 46. The ACE bookkeeper pays $6,000 for 1 year insurance policy. We'll do that on another date. So we will count that as, we'll put in the date as 5/7. That's arbitrary. What 2 accounts are being affected? What accounts are being affected? Well, we have a prepaid insurance and we have cash. Which is increasing, which is decreasing? Well, we paid with cash, so obviously cash is decreasing. We didn't have an insurance policy. We bought a policy. We paid the premium for the policy. And because we paid a premium for the policy or the prepaid insurance went up. So now we know which one's increasing, which one's decreasing, which one's debited, which one's credited. Well, if prepaid insurance, which the prepays is an asset, so prepaid insurance is our debit. Debit is on the left, so I'm going to write prepaid insurance. I'll put INS for insurance. And that was for $6,000. We debited cash, so cash is indented for $6,000. And the description was bought 1 year insurance policy. That would be just enough. You don't have a lot of room, so abbreviate as much as you can, but you don't want to lose the understandability of your transaction by abbreviating too much. This is sufficient. It says bought 1 year INS. INS is in short form or abbreviation for insurance. Now, let's pretend that that's all the transactions we have for this period. So now that we're done with our journal entries, this is the end of the time. We would normally go from journal entry every day to post to the GL, but let's just say that we only have 2 transactions we're going to post now. So we're going to take the date, 5/1. Description was owner deposit, DEP, in account. And that was a debit of $30,000. So we put the $30,000 here. 30,000 under the debit column, and the balance is a 30,000 debit. And this is the cash GL. So I'm going to put it in cash here so you know I'm talking about the cash GL. This is all posting into the cash. The second transaction here is on 5/7. 5/7. The description is bought insurance. I'm just going to put bought insurance just to make it simple. You would use the same description, but I'm running out of room. This is a credit of 6,000. So that's going under the credit column, 6,000. And the balance is actually you have 30,000 minus 6 makes it 24,000 debit. We're still at a debit balance. It's very important that you understand how this works. Always put the debits first and keep them together. If there's more than one account that's being debited, they both go together. If there's more than one credit account, then they both sit together. But they must be debits first and credits, then description. When it comes to the GL, you only merely have to post the amounts and have this running balance. That is important, is this running balance, because now we can look at the GL. If I were to ask you, what is the balance of the cash account at the end of the day on 5/7? You can immediately tell me it's $24,000, right? Now that we've gone through our first portion of the accounting cycle, which is recording transactions using JEs, journal entries, and then posting them at the end of the day because of the journal to the general ledger and posting them here. Now let's talk about the next stage of the accounting cycle, which is the adjustments cycle portion. Adjustments are done at the end of the month. So at each period, usually accounting period is a month, where a fiscal period is 12 consecutive months. Typically, it's a calendar year, January to December, but some companies have a different start and end point for their fiscal year, which is, again, 12 consecutive months or 4 quarters. But we're going to talk about in a typical month, and that's the cycle. The accounting cycle happens in a month cycle. So the first day of the month, we start the business of that month, then we go through the entire month, and then we end that cycle and close the month at the end of the month. So we're going to do the adjustments. So we'll do the adjusting journal entries, then we'll post those to the general ledger, then we'll do the trial balance. So what are some adjustments? Well, we talked before when we did our first cycle, we had a transaction for pre-insurance. Prepaid insurance was the account we used, and we paid with cash. So we debited prepaid insurance for $6,000, and I'll put that right here so you know what I'm talking about. $6,000 for 1 year of insurance on April 1st. We'll use April 1st as our date, on April 1st. At the end of April, so 1 year is also the same as 12 months. So if in a 12-month period we've paid for $6,000 worth of insurance, after each month, at the end of each month, we have used up 1 month of the 12 months of insurance. So we can't say that we have 12 months of insurance at the end of April because we have exhausted the use of 1 month. We've exhausted 1 month of protection. It's over. We don't need to be protected anymore. So we need to show that the prepaid insurance is exhausted and by 1 month. 1 month, or if we divide this by 12, is $500. So each month we have to do an adjustment of $500 to the prepaid insurance account. How do we do that? The adjusting entries also are always done at the last business day of the month. Not necessarily the last calendar day, the last business day, because we don't have business on weekends generally, and accountants are a Monday through Friday type of job. Not that it's an 8-hour job, but it's a Monday to Friday type of job, generally. So, how do we do this transaction right here? How do we put it in our JE, and how do we put it in the GL? Well, first let me put in that the GL we're going to use today in this portion we're going to call it the prepaid insurance GL. Recall that we did this transaction on the first. So I'm going to write that in the JE so we know that. Just as a reminder, on 4/1, so what two accounts were done or used when we did this transaction on 4/1? Well, we paid the insurance, and it was prepaid for the coming year to start next month, but we'll use April 1st as our date. So we prepaid insurance. Therefore, one of the accounts is prepaid insurance, which is our prepaid account. And you know that prepays are an asset, are in the asset side, are assets. What did we pay it with? We paid it with cash. So on 4/1, our account was prepaid insurance for $6,000. That was our debit. Remember, debits before credits. And then we indent the credit. So credit's going to start over here. We credited cash because we paid it in cash, $6,000. And we're in balance, right? Yes, we are in balance. Okay, now we fast forward to the end of the month. And at the end of the month, for the ease, we're just going to pretend that April 30th was the month end, or the last business day, of the month. So now we're going to do our adjusting entries, and we do the adjustments before closing. So we have to adjust now that we have now exhausted 1 month of insurance. So what do we have to do? Well, we're going to use a new account, and it's going to be called insurance expense. Insurance expense, we're going to debit. We always debit. Generally, we always debit expenses. So the expense is going to be debited by how much? The $500. But what are we going to credit? Well, we can't credit cash. We've already credited the cash, and we're not getting any cash. We're not spending any cash for this expense. This expense has already been expensed as a prepayment. So we're not going to spend again more cash, and who are we going to pay? We've already paid for the insurance, so we're not going to pay the insurance agent again. We can't pay him twice. We paid him $600. We're not going to pay him an additional $500. So where is that $500 going to go? Well, remember that we've prepaid $6,000 in the prepaid insurance. So there's that $6,000. So we're going to credit the prepaid expense because prepaid expense is going down. We've used up 1 month, so there's only 11 months left inside there. How much is 11 months left of a prepaid insurance? I'll show you. Watch this. Here's the magic. Here's some magic going to come up. Watch this. So let's pretend that we only had the one transaction on the first, which was this prepayment of insurance that we paid. So let's post that to the GL on 4/1. We prepaid 1 year, prepaid 1 year of insurance. And that was a $6,000 debit. So we put that under the debit, and that is the opening balance. That is our opening balance of the account as of April 1st. Now let's post, now we're at 4:30, fast forward to the end of the month, bing, now we're at 4:30. And now let's post this transaction. The date is 4:30 and used 1 month insurance. That would be a close enough. I'm not too concerned about what description you use as long as it's a consistently understandable, it's consistent and it's understandable, that anyone could read it and know what you're talking about. And that was a, look at the prepaid. If we if we focus only on the prepay insurance figures, we have a 6,000 here for prepay, and we have a prepaid insurance account here for 500. This is a debit, this is a credit. It's in a credit column. So we put 500 over here. So what's the balance now of the GL? What's the balance in the GL? Well, 6,000 was as a debit balance. This is a credit, so we actually subtract it. And now we can easily look at the GL and say, how much do we have left of our insurance? We have 11 months. 11 months or $5,500 of premium left. And that's why we use the GL. Now we can look at the GL balances and know exactly what the ending balance is at any date. At any point in time, we know what is the balance of those accounts because the GL will tell us. How about another type of adjustment? So let's consider another type of an adjustment. We've talked about prepay, which is one typical type of an adjusting entry. Another one is interest. Let's consider that you borrowed money on the 1st of April for $10,000 at an interest rate of 12% for 1 year. And at the end of that year is when you have to pay the whole thing. You don't make monthly payments. We're going to pay the whole loan all at once. Interest and the principal. This is the principal amount, and this represents the interest rate. And it's always, always, always. Another thing you want to remember, I've given you a lot of things to remember, and here's another thing, that when you see an interest rate, unless it expressly states otherwise, an interest rate is always given as an annual rate. So 12% represents a year's worth of interest. That's an annual rate. But we are going to do our adjustments per month. So what is the monthly rate of interest? If 12% is 1 year, what is 1 month? Well, we take the interest rate and divide it by 12. I made this easy because that's equivalent to 1% per month of $10,000. So every month we have to accrue this. And an accrual account we're going to use is called interest payable. Because we owe it, we don't need to pay it. So it is payable. Able to be paid, but not paid. So we're going to use a new account called interest payable. And that's the adjustment we're going to use at this point. So we're going to change this account from prepaid insurance. We're going to call this the interest payable. Interest payable account. How do we write this transaction? We got this money on April 1st, is what I said. And so at the end of April, we owe 1 month of interest. It's not paid. We don't need to pay it for another year, another 11 months, but we need to show that we owe interest. And that not only tells us, but tells everyone who looks at the financial statements that there is an account that we created because of this loan. So on 4/30, and by the way, from this point forward, I'm going to drop the year. We don't need to write the year when we're talking about transactions all in the same year. We're just going to make it a little simpler. So from this point, from the next example forward, I'm going to drop the year just for ease and for the space. I'm limited on space, as you can see. So I want to be most efficient with my space, and I'm going to drop the year. We don't need it. It is not absolutely necessary unless you have transactions that cross between years, between fiscal periods. Then you will definitely need to know the year, because a transaction that happened 1 year may follow through and bleed over to the next year. In fact, if we borrow this money in April of 2020, it's due April 2021. So these accounts are going to translate through to another year. We'll see why that. So now we're going to talk about interest and how much interest is going to be charged here. We are going to talk about 1% of $10,000. That's equal to $100 per month of interest. Okay, so we know the amount. What accounts are being affected? And I will tell you this now, those 5 steps will start to become more and more commonplace as we do these transactions. We won't have to say the full 5 steps over and over again. So what 2 accounts are being affected? Well, I just said interest, so we owe the interest, and so if we owe it, it's because of payable. So there's interest payables included, and that's, I gave it away right there. We're going to have a GL, therefore we're going to have some sort of account that we're going to do a transaction for, therefore, or otherwise we wouldn't need a GL for it. So I gave it away. 2, so we know that interest payable is going to be affected. What else? Well, there's an account we are going to talk about, and we're going to create right now, called interest expense. We have to show that we spent money, even though we didn't spend cash. We have to spend it and account for the spending, even though we're not paying cash for it. We owe it, but we're not going to pay it. So it's an expense. We're going to have interest expense. I'm making it INT. INS is insurance. INT is interest expense for $100. So we're debiting $100 from the expense. And then we have the interest payable account for $100. And we accrued 1 month interest. There's our JE for it with the description. Now we're going to post it to the GL. And we're posting it as a 430. Accrued 1 month interest. And it's a credit in the payable, is a credit of 100. The balance is 100 credit. 2 examples of adjusting entries. Before I go to the closing and the last stage of our accounting cycle, and when the accounting cycle cycles all the way, and then we start over again, there's a couple of things I need to drop on you. First, what is a trial balance? Remember that the accounting cycle starts with our JEs, then we do our JE, or journal entries, sometimes called the general journal. We enter our general journal entries. At the end of that day, we post everything to the GL, and that end of day balance is the balance of the bottom balance of that balance column of the GL. What is a trial balance? Well, occasionally, and usually it's at the end of, close to the end of the month, but some accountants like to do it on occasion to catch mistakes. We do what's called a trial balance. The trial balance. The trial balance puts into perspective all the debits and all the credits that have been done in a particular cycle or period. And we have a first level or regular trial balance, then we do an adjusted trial balance for all adjustments, then we do a closing trial balance, or what's called a post-closing trial balance, to continue that step of verifying that all credits and all debits equal. The debit column and the credit column should have an equal balance. If not, then we can immediately see where we made a mistake. We may have put a debit where credit belonged, or vice versa, and reversed a couple of transactions that should have been, and then the balances will be off. It doesn't correct if we use the wrong accounts, but it does correct whether we do the debits and credits correctly. Now, the order of operations when it comes to a trial balance is this, and it's very important that you put it in this order, because from this order is how we can easily create our financial statements, balance sheet and income statement, the first two main of the four financial statements. The four are balance sheet, income statement, statement of owner's account, or statement of stockholder equity, or statement of owner's equity, and the fourth one is the cash flow statement. Again, the cash flow statement we will get into at the end of class, and it uses a lot of this information. So the order that you want to put your trial balance in is, in the rough order, you start off with your assets, and most particularly you start off with all the current assets, then your fixed assets, then you go to your liabilities, and specifically we start off with our current liabilities, then our long-term liabilities, then goes to equity, and that would be your capital, any changes in your capital. The next step is revenue and all the expenses. In that order. Now, in the beginning, I'm not so concerned which current assets you put in which order. There is an order that, because of the in current assets, it tends to be in descending liquidity. Cash is the most liquid, so it will be at the top. Accounts receivable, inventory, and your prepays and other accruals. That's kind of how it works. With fixed assets, I'm not too concerned about the order. Current liabilities, again, not too concerned about what order you put them in. Accounts payable is usually the first one, and the other payables are following below that. And long-term liabilities, not really concerned about the order either. And also with the expenses, there's only one revenue, so there's no order to that. It's one. So you would basically, on a trial balance, you would put cash, accounts receivable, inventory, prepays, would be your current assets, your fixed assets, your property, plant, and equipment, which I will put as PPE, not personal protection equipment. That's a different PPE. You probably hear that a lot now. What is PPE? Currently, we created that acronym really, or it's become more popular because of COVID-19, and the health professionals and everyone grabbing PPE for protection. You'll see your COs probably wearing PPE now more often, and I'm not sure, maybe it's being distributed to you, students, for your own protection, self-protection and the protection of your fellow students. But in this case, in this particular case, and it's been used much longer, PPE stands for property, plant, and equipment. I use that as basically a catch-all for the majority of fixed assets. Then we have our current assets, our current liabilities like AP and other payables, like interest payable that we had earlier. Long-term, any long-term debt, I'm going to put LT debt. Or notes, like I said before, we use the word note, debt interchangeably. Then we have our capital. Then we have our revenue. And then all our expenses. I want to focus your attention on a little bit here on something very important when it comes to trial balance. The trial balance is the balances of each of these accounts at the end of the period, whether you're talking about the end of the week, end of the month, whichever period you're looking at, or if you're doing it periodically and looking at it, making a trial balance. It's that date. It's the balances of the GLs. So what general ledger balance is for cash, accounts receivable, payable, all the payable accounts, individually. They'll be listed individually here on the trial balance. I've lumped them into more broader categories for description purposes only. So, typically, cash may or generally would be a debit balance, but not always. If it's a credit balance, you're in trouble, but only for that period. But accounts receivable typically has a debit balance. I'm putting an X here, so you would be putting a figure there. It's an asset. Inventory typically has a debit balance. Prepays would have a debit balance. Fixed assets would have a debit balance. AP, as a liability, will have a credit balance. And other payables will have credit balances. Your long-term debt, which is a liability, has a normal credit balance. Capital will also have a normal credit balance. Revenue always has a credit balance because you never, ever, never, never, ever debit revenue. And expenses typically have a debit balance. And when you add these together, this number here should equal this. The adjusted trial balance is the same basic structure. What is included in the adjusted trial balance would be any account that we had created because of the adjustments. When we recall also back in the first chapter, first lecture, we went through a series of T accounts with different transactions. And on this side of the board, I had several expense accounts because of normal day-to-day operations. We had telephone bill, we had salary expense, and so on. We had rent expense. Those are expenses that are spontaneously created and kept because those are regular expenses, but they were created at the time that we received the bills. We received the bill for the rent. Typically you don't, but meaning that you know that the rent is always due at the first of the month. So you're always paying a bill, paying the rent. But we got a telephone bill. And those were created or used throughout the month. But at the end of the month, there are expenses that are created or used, opened up, accounts that are opened just because of the adjustment. We had insurance expense That was a new expense that wasn't here before the adjustments, but after adjustments they came to be. So the adjustment, the accounts here may grow because of the adjustments. We'll have extra or additional expenses. We had the interest expense. That expense was because we calculated at the end of the month how much interest we owed at the end of April. Not paid, but we owe. And that would be another expense that would be here. So an adjusted trial balance may have additional accounts that we're adding. Some of them will be also adjusted or differences in these balances. We may have more or less by the time of the adjustment, by the end of the month, we may have more or less cash. We definitely know that we have less prepays because we had to credit the prepay of insurance to expense or debit the expense of insurance expense. So the balances on an adjusted trial balance, these columns may not add to the exact same amount as a previous trial balance or the trial balance, any trial balance previous to the adjustments. Just know that we do the same thing again, the same process to make sure that we continue to stay in balance. We're always looking for balance. Remember, are we in balance? Boom. Yes, boom. Yes. Are we in balance? Yes. Boom. And that's why we're constantly having to look to make sure we're in balance. Is our trial balance in balance? Yes. Boom. Is our adjusted trial balance in balance? Yes. Boom. The last thing we're going to talk about when we're doing the accounting cycle is the closing entries. Why? Well, there are two types of accounts. There are permanent accounts and there are temporary accounts. Temporary accounts are only existing or have a balance, existing balance, in a particular accounting period, usually a month. And then we close that and close all that information to permanent accounts that transpire or exist from period to period. Balance sheet accounts are permanent accounts, like assets, liabilities, equity. Any of those accounts that were used or described in the balance sheet are also called permanent accounts. The income statement accounts, revenue and expenses, net income, those accounts are considered temporary. When the door opens on January 1st, how much money did you make? You just opened the door. Nothing. You have no revenue and no expenses because you haven't sold anything yet. But you opened the door. And the door existed before January 1st. Before you opened it, it existed. That's an asset. The door, which is part of the building, is an asset. An asset exists, and it's a permanent existence. So it's a permanent account. It existed before you did any business. And it will exist after you close that door and walk away. It still exists. So we need to close out our temporary accounts to adjust. This is another adjustment, but the final adjustment of the month is to adjust the temporary accounts to permanent accounts. So we are talking about revenue. The normal balance of revenue is a credit. And I said earlier, you never, ever, ever, never, ever debit revenue. This is the only time you're going to debit revenue, and that's in closing. Not under normal business. This is part of the accounting cycle. The accounting cycle is the closing part. So let us, and the accounting cycle is always done on the last day of the month. So 4/30. Now, there's two methods of closing. There's the direct method and the indirect method, or the direct to the capital method, and the income summary method, not income statement, income summary. I typically think of the income summary as retained earnings. It's the same thing. Our textbook uses the phrasing or the phrase income summary, so I'll continue to use that, not to be confusing. So it's consistent with the textbook. So when you go back to your and read your textbook, you won't be confused about what I'm saying. But most often we use retained earnings as the account, not income summary. But we're going to use income summary. That is an account. So when we do our closing, the first thing we close out in our temporary accounts, remember all the revenue and expenses are the accounts, is we close out revenue. So we do JEs also. We do closing JE closing entries. That's why they're closing entries. We have daily entries, we have adjusting entries, and we have closing entries. And we're talking about closing. So the normal balance of revenue is a credit, so we have to debit revenue to zero it out. What do we credit then? If we're debiting revenue, we're going to credit. So I'm going to show you the direct method, and then I'm going to show you the indirect method. So in the direct method, we credit capital for the amount. And that's the balance of the revenue GL at the end of the month. On April 30th, what's the balance of the revenue GL? And that's the amount we're going to do here. The next step is to close out the expenses. Well, expenses, the normal balance of an expense is a debit. So we're going to debit capital and credit the expenses individually. And I don't mind if you do this all as one step in the JE, as long as you list all the expenses individually. So you can make sure the balance is balanced. So make sure this has been balanced, I mean. And the last thing and that's the end. In the direct method, that's the end. We're done. We're done closing. What does it look like from this perspective? From a GL perspective. On 4/29, we had a transaction that credited it for, and let's pretend that we will forget about the description, but the balance of the revenue account was $100,000. That's the balance as of 4/29. So we have to close out this revenue GL because it's temporary. So we're going to do a debit for $100,000 and credit capital for $100,000. That's our transaction. Now let's post it over here. I'm just pretending that we had a transaction of 4/29 just to come up with it. So on 4/30, this is closing the revenue, so it's our closing. We have a debit of $100,000, which makes this balance 0. The GL is 0 now. The same would be with all the expenses. The debit balance of the expenses are credited off and debits capital. But I said there was two methods. And here's the second method, the indirect method or the income summary method. And this is truly the additional or the differences between the two. With the direct method right here, we are done with the closing. We don't close. The net income is not an account. The net income is the difference between expenses, revenue, and expenses. Watch this magic. This is the indirect method. We're not done. But first thing is, we substitute the word capital, which is the direct method, to the income summary method, or retained earnings. There's going to be an additional step. And it really depends on whether the income summary ends up because of these two transactions, whether it ends up as a debit balance or a credit balance. If it ends up in a credit balance, we would debit the income summary and credit capital, that extra step. If income summary has credit balance. Otherwise, these two would be switched, and we would debit capital and credit the income summary. I'm putting as AIS if the IS has a debit balance. And just to note, these are two separate situations. It depends on what the GL balance of the income summary is. If our income summary GL, which is new now because the indirect method, has a balance that's a debit, we would have to credit the income summary and debit capital. If the income summary has a credit balance, then we would debit the income summary to make this 0 and credit capital. These are two separate situations that you will run into because of the closing. The last step in the closing process is to create a post-closing trial balance. Remember, we had a trial balance after all the transactions at the end of the month. Then we did our adjustments. We had our adjusted trial balance. Now we have our post-closing trial balance. And that will look slightly different than the previous two trial balances we looked at. But it's still very important to note that the debit column and the credit column must equal, must be in balance. We always have to be in balance. In the post-closing trial balance, there's only one major difference. We still have our current assets, like cash, AR, inventory, prepays, PP&E, as I mentioned, is fixed assets. So your current assets, your fixed assets, your AP and other payables, your long-term notes or debt, and capital. But this is post-closing, so it's after we closed what? It's Post means after, so we're after closing what? It's closing out our temporary accounts. So revenue and expenses are not included in the post-closing trial balance. All the other permanent accounts are there. These are the permanent accounts. The temporary accounts have been closed. It's post-closing. So revenue's gone, expenses are gone. In the post-closing trial balance, only the permanent accounts remain. And those are the current assets, fixed assets, current liabilities, long-term liabilities, and equity, which is in capital.